China's plan to tank their own stock market. James Rickards. When I say the fix is in for FXI, that's not meant to be mysterious. FXI is the ticker symbol for a U.S. exchange-traded fund composed of the largest Chinese stocks. The phrase "the fix is in" simply refers to government-backed manipulation. When you combine the two into a government plan to tank their own stock market, at least to a point, you're as close to a sure thing as stock market indexes allow these days. That's exactly what's going on in China right now. A currency devaluation will likely lead to a stock market collapse, but it's a trade-off China is willing to accept because a cheaper currency will stimulate exports and support jobs. China's motives in market manipulation are about social stability more than profit and loss. Of course, the Chinese have nothing against making money, they're good at it. But China is controlled by a Communist Party dictatorship that is most concerned about its self-perpetuation. That self-perpetuation can involve prison camps, thought control, and torture if needed, but on a day-to-day basis it's more likely to involve avoidance of inflation, unemployment, and market panics. Investors with vague or no recollection of the 1989 Tiananmen Square protest and massacre in Beijing have been taught to recall the event as a pro-democracy student rally complete with a 33-foot-tall papier-mâché statue called the Goddess of Democracy that was destroyed as the military cleared the square. That's a highly selective and misleading portrait of the overall protest. It's true that student demonstrators placed demands for more freedom of the press and freedom of speech in their petitions. Yet the origins of the protest were economic. Rapid economic growth in the 1980s had resulted in large gains for some but had marginalized and disgruntled many others. Inflation was a real tax on those with limited resources and an easily avoided inconvenience for the rich. It was these economic grievances, inequality and inflation, that gave rise to the protests. The pro-democracy aspects were tacked on in the later stages as the crowds grew. Initially, the Communist Party leadership was divided between moderates, like Zhao Ziyang, who favored some dialogue with the protesters, and hardliners, like de facto leader Deng Xiaoping, who favored a forced breakup of the protest and the arrest of its leaders. In the end, the hardliners got the upper hand and the result was a violent military attack on the demonstration. Death estimates vary widely and cannot be verified but range from 1,000 to 10,000 dead protesters. Communist Party leadership itself was thrown into chaos in the aftermath of Tiananmen, with Zhao Ziyang being purged and Jiang Zemin being installed as the new hardline party leader. The ghosts of Tiananmen still haunt the Communist Party leadership almost 30 years later. Economic warfare between China and its trading counterparties is not mainly about economics. It's mainly about social stability in China, which means avoidance of new mass protests and suppression of widely voiced political dissent. This econo-political history brings us to the ongoing trade war between China and the U.S. A superficial account of the trade war says it was started by President Trump last winter with his imposition of tariffs on Chinese goods imported into the U.S., including steel, aluminum, and certain appliances. China retaliated with tariffs on U.S. imports. Trump doubled down with U.S. tariffs on a much longer list of Chinese goods and imposed penalties for Chinese theft of U.S. intellectual property. China retaliated again, and Trump doubled down again. These tit-for-tat tariffs were rising in $10 billion bumps. Suddenly the happy talk about posturing and empty threats was swept aside. A full-scale, red-hot trade war was underway. This recent outline is accurate as far as it goes. Yet it leaves out a much longer and more complicated backstory. On December 11, 2001, China was formally admitted to the World Trade Organization, WTO, the legal successor to the General Agreement on Tariffs and Trade, GATT, one of the original Bretton Woods institutions from 1944. China's admission to the WTO was the result of years of negotiations and substantive concessions on the part of China. Despite those perceived concessions, China secretly pursued the same policy it has used at the UN Security Council, the IMF, and other multilateral organizations it has joined in recent years. Here's an easy metaphor that captures Chinese behavior. Imagine you're on the admissions committee at an exclusive club. Your club has a strict dress code that involves jackets, ties, and leather shoes even on casual occasions. A new potential member has applied. They go through the interview process, bring recommendations, are informed about the dress code and agree to strict adherence. The new member is admitted. The next day the new member shows up at the bar in cutoffs, flip-flops and a t-shirt. Your club has a problem. China's the same way. They go through rigorous vetting. The organization rules and procedures are carefully explained. China agrees to play by the rules and is formally admitted. The next day, China proceeds to break every rule in the book and, in effect, dares the leadership to sanction them. The sanctions never arrive. The group has a problem. From this perspective, the trade war did not begin in 2018, it began in 2001. It was not started by President Trump, it was started by China through rule breaking, theft of intellectual property, export dumping and slow-rolling open markets. When China joined the WTO, its trade surplus with the US was about $100 billion per year. Today China's trade surplus with the US is about $400 billion per year and rising. This surplus is in addition to the theft of over $600 billion of intellectual property. The 17-year wealth transfer from the US to China now exceeds $3 trillion. Viewed this way, Trump's 2018 tariffs on China were not the start of a trade war. They were a desperate effort to stop one before the US is looted further by the Chinese. In the short run, China has been able to see Trump's ante every time Trump increases tariffs. Yet China is crucially weak on this front. The US imports about $500 billion per year in goods from China and exports about $100 billion to China. The difference is the $400 billion per year trade deficit the US runs with China. China is getting close to tariffs on 100% of US imports. The US can still impose tariffs on another $400 billion of Chinese imports. This is what Trump referred to when he said the US cannot lose the trade war with China because we already lost. Trump's hope is that China will see it's playing a losing hand, meet Trump for negotiations and settle on lower tariffs all around. This could expand bilateral trade and be a boost to the global economy. So far, China has not sought reconciliation. Instead it has injected a currency war tactic into the trade wars to give it more leverage than would otherwise exist. Here's a chart that shows the radical devaluation of the Chinese yuan, CNY, against the dollar, USD, in the past 4 months. This currency devaluation is China's reply to Trump. If the yuan dropped 20% against the dollar, Chinese export costs would drop by about the same amount because yuan unit labor costs are a huge part of Chinese manufacturing costs. If Chinese export costs are $100 per unit, a 20% devaluation will lower those costs to $80 per unit. A 25% US tariff on the new $80 baseline will raise the export cost to $100, exactly where it started. China has discovered that devaluation is a near-perfect offset to tariffs. The devaluation tactic not only lowers Chinese export costs, it increases US export costs, as shown in Chart 2 below. With the trade wars and currency wars now commingled, what are my predictive analytic models telling us about the prospects for Chinese stocks in particular and China more broadly? Right now, they're telling us that China is not backing down from its aggressive response to Trump's tariffs. The Trump team shows no inclination to back down either. The result will be constricted bilateral trade and slower growth at the margin for both countries. A declining Chinese stock market, as reflected in the FXI price, will be collateral damage in this escalating struggle. It's not a result that China wants, but it's a price they will pay in order to keep Chinese citizens employed and assembly lines humming. Lower unit labor costs combined with higher US tariffs will shift wealth from Chinese enterprises to US importers, but there should be little change in the local currency earnings and job security of Chinese workers. That's the line in the sand the communists will defend. The combined trade and currency wars are like a perfect storm aimed at FXI. Wall Street is misreading these developments, but you don't have to. Stock market braces for rebound. After the stock market entered the bear territory in the first 6 months of 2018, it bounced back in July and is expected to sustain its strong rebound in the coming months. From a record high of 9,078.37 points in January, the bellwether Philippine Stock Exchange Index plunged over 20% in June to 6,923, as inflation rate accelerated, driven by various factors such as the implementation of Package 1 of the Duterte administration's tax reform agenda, steady rise in world crude prices and tight supply of rice. Foreign investors have exited the Philippine equities market since February mainly because of the aggressive U.S. Fed rate hike and the strengthening of the U.S. dollar. Concerns over the US-China trade war and the delay in interest rate hikes by the Bangko Sentral ng Pilipinas are hurting investors' sentiment. As a result, foreign investors have become net sellers by P68.6 billion as of August 3, while the average daily turnover shrank to P7.2 billion. Analysts, however, remain optimistic after the benchmark index began to recover at the start of the third quarter. It slowly climbed back from the bear market zone to reach the 7,800-point level. This could be attributed to the positive outlook on the domestic economy, robust domestic spending despite the implementation of Package 1 of the tax reform for acceleration and inclusion law, and strong corporate earnings. First Metro Investments Corp Vice President Christina Olang said in a briefing she expected the PSEI to rally back to the 7,900 to 8,200 levels in the second half. Olang said one key factor that could push the market higher was the sustained growth of the gross domestic product. The economy expanded 6.3% in the first half, just below the government's target of 7% to 8%. Corporate earnings are expected to deliver a 10% growth this year, while the fiscal stimulus from the massive infrastructure projects the government plans to undertake would also be a key consideration and catalyst for the equities market. Fundraising initiatives in the capital market is also expected to recover in the second half, after a slowdown in the first 6 months because of the volatility in the equities market. First Metro said capital raising this year was expected to grow by 7% to P773 billion, of which P220 billion would come from the equities market and P553 billion from fixed income issues. Online brokerage firm COL Financial is more optimistic about the market, expecting the index to hit 8,600 points by the end of the year. COL Financial Research head April Lintan said there were strong indications the market already hit the bottom at the 6,923-point level, including the magnitude and duration of the ongoing correction. We continue to recommend slow accumulation of a diversified portfolio of stocks using long-term money, focused on blue chips that trade at attractive valuations, Tan said. She said most negative developments in the local and global front were already priced in the current valuation, thus the market was just waiting for fresh catalysts before resuming an upward trek. These catalysts include inflation moderating from its peak, corporate earnings growth beating estimates, the US Fed stopping rate hikes, and US-China corporate earnings remaining strong even with the trade war. Tan said she was also expecting the domestic economy to remain resilient and strong, which would continue to favor property, financial, gaming and retail sectors. She said despite the rising interest rates, she preferred the property sector because the rate increases remained generally acceptable, which could enable real estate companies to expand their residential sales. The rate increases are not the kind of increases which aim to prevent a bubble. We not yet overheating for BSP to be aggressive in raising rates, Tan said. Tan is also bullish on the telecommunication sector despite the possible entry of a third player. On telco, the delay in the announcement of third telco player has allowed Globe and PLDT to strengthen their positions. It would be difficult for the third telco to compete financially speaking, because Globe and PLDT have become stronger, Tan said. Tan said for the cement sector, prices started to improve while demand was expected to pick up. Meanwhile, the gaming sector continued to enjoy strong gross gaming revenues. Tan's stock picks in the property sector are Ayala Land Incorporated and Mega World Corp., while her top choice for gaming is Bloomberry Resorts Corp. For banks, Tan likes Metropolitan Bank and Trust Company and Security Bank. Among consumer stocks, she favors DNL Industries. For power, Tan is betting on Semirara Mining and Power Corp. For conglomerates, she eyes Ayala Corp. Tan's other top picks are Globe Telecom for telecommunication and Eagle Cement for cement.